Good morning, everyone. We're just going to wait a minute while everybody joins us, and then we'll get started. Okay, I think everyone's here. So here we go. Good morning. Thank you all for joining us. We hope that you're well and safe wherever you are. My name is Chris Nelson, a Senior Director of Development and Director of Planned Giving at Wittenberg University. And I'm so pleased that we can kick off Wittenberg's Homecoming 2020, a homecoming unlike any other, with such an important conversation and a topic that affects every one of us. So a quick housekeeping note, questions can be submitted during the presentation using the chat button located at the bottom of your screen. And Elizabeth and I will also take questions at the end of the presentation if you'd rather hold on to them until then. So with that, a few words about our presenter today. So Elizabeth Ayers is the Executive Director of Gift Planning at the University of North Carolina at Chapel Hill. She's a former member of the Board of National Association of Charitable Gift Planners and served as the chair of the 2017 National Conference on Philanthropic Planning. She was just named Crescendo Integrated Marketing's 2020 eMarketer of the Year. Elizabeth has presented on various charitable topics at local and national conferences, including the National Association of Charitable Gift Planners, Crescendo, Association of American Medical Colleges, Wealth Council, and the Association of Fundraising Professionals, North Carolina State Conference. Prior to joining UNC in 2008, she worked at The Ohio State University, as well as the Columbus Foundation. And in addition to her Bachelor of Music degree from WIT, she holds a JD from Capital University and a Master's of Music from Ohio University. So I want to introduce a proud Delta Sig Lil Sis, Elizabeth Ayers.
Thank you, Chris. Good morning, everyone. It is truly delightful to be here with you for the first hour of our homecoming kickoff and 175th anniversary.
Thank you so much for joining us this morning, and we're really interested in what you have to share with us. So we'll jump in. For someone who has maybe never created an estate plan, or maybe it has been a while since those plans have been reviewed, what can you tell us about the process and the various considerations when planning an estate?
Well, first of all, you really need to think about what your values are today. What is important to you? Who do you want to look after, and what do you want to happen when that final event occurs? Before you go to your estate planning attorney, I think it's good to do a couple of things, because when you are there, you will be doing, as you can see on the screen, you will be doing your healthcare directives as your power of attorney for living will, power of attorney for any healthcare when you cannot make that decision, a durable power of attorney for finances, and either a will or a trust. So you're going to have to think about, even if you're married and you'll say, well, my spouse will take care of everything, you always need to have backups. So you need to think about who you trust to make these important decisions. And you probably should make a list of what you own, all of your accounts, your assets. Be thinking of that and trying to get as organized as possible. The thing that I think that helps the most is to talk to your cadre of advisors. And by that, you probably have a financial advisor or an accountant who can advise you as to what you need to think about with beneficiary designations, how your assets may or may not work. And if you are charitably inclined, Chris, as you know, as gift planners, this is our field. We love to sit down with our donors, alumni, and advisors and talk about what they want to do and help them craft some ideas so that when they go to their estate planning attorney, they can say, what about this?
What I like about that picture that you're painting is that you're assembling a team that's there to help you and listen to your interests and help guide you through the entire process. So you have your team, you've taken stock of what's important to you and brought that to the table, if you will. What are the reasons and benefits of creating or revisiting your estate plan?
Well, always remember, and I tell all of my donors this when I talk to them, it's peace of mind. It's not death planning, it's peace of mind. It's a way to show your current values. But there are all sorts of reasons. There can be changes in your affection. You may have concerns about family or loved ones you want to protect. Changes in wealth will bring you back. Changes in law. I mean, I've been in gift planning 21 years, and I cannot believe how many times the tax laws have changed. And so it is always good to revisit your plan. And I used to tell my clients when I practiced, don't go more than 5 years. Now, if you know there's a huge change in between, get back there. But even if nothing like this has changed in your life, you probably don't want to go more than 5 years without looking at your plan and saying, does this still reflect my values and wishes? So, in one example, I had clients come to me years ago, and the husband was totally resistant to doing his estate plan. He said, well, we don't have that much. Why do we need to do one? So I started asking him questions. Do you have tangible personal property? Do you have your own accounts? Do you own your own cars? Do you have children? Who's the object of your affection? Well, I just assume my wife will get it all. And I said, well, that's not how the statute for intestacy works. You really need to take care of things. And so once we talked through it, he's like, oh, you're right. And so they did their will and their powers of attorney and everything else.
Yeah, so let's pivot more toward the charitable component, because for many people, using philanthropy to leave a legacy through their plans is a really important piece of this entire process, and a component that a lot of people think about when they consider what to do during their estate plans. So, how do you define gift planning?
I define gift planning in different ways, but I define it as a process now. And you can see I have the definition on the slide there, but it really is a way to look at all of your legacy wishes, but also your concerns, personal and financial. And I think it's important to note that Robert Sharp is a leader in our gift planning industry, and I love this quote. He says, most deferred gifts are planned, but not all planned gifts are due. And there are ways to tax-wise smart or otherwise smart to do current giving as well. And as we go through this morning, we're going to talk about those ways. So gift planning is a broad structure, but it really is a process. It's also, Chris, it's about solutions. And I like to think of it in that way. And if I may provide another example as to what I mean, when I was at the Ohio State University years ago, I had a donor come to me, and it started out with a conversation. He was a World War II vet. He had taken advantage of the GI Bill, and he wanted to set up a scholarship. And we started with that, but we also found out that he had concerns. He was in his early 80s. He and his wife, who was not in the best of health, were moving into an upscale retirement home. And so they knew there were going to be some expenses. So even though he wanted to have a huge impact, he wasn't sure how much of an impact he felt comfortable doing now. He also had another concern. He had two lovely daughters, happily married, employed. Both of them were employed in their 50s at the time. But the one daughter liked to spend everything she made. And so he wanted to find a way to protect her after he and his wife were gone. So we ended up with a conversation that we thought was we started with a conversation that we thought was going to be a $50,000 scholarship now and maybe a $500,000 testamentary charitable trust when he and his wife passed. But as he thought about it, and as we discussed trust and we discussed his situation for 2 years, it ended up being $4.5 million went into a testamentary charitable remainder trust. And I like sharing this story because Ohio State is not the only beneficiary when it comes to fruition. The other beneficiary is Wittenberg. So that's one of my favorite stories. I was excited that I got to help with that. But by working through, thinking, talking, he realized he could A, have a lot more impact, and B, protect his daughters, and C, not have to really use the money right now in case he and his wife needed it.
Yeah, wow. It sounds like you're looking at estate and charitable planning. You're looking at a variety of issues, and for the example that you just shared, it may be important to start with the end in mind before figuring out the details.
Um, that's a good point. If you want to show the next chart, this is one of my favorite charts, Chris. And this is how I like to help explain the process. I used to call it 3 buckets. You can look at it however you want, but it is important. What are you excited about? So what do you want to do for Wittenberg? Do you want to honor a family member? I mean, I have a family tradition. You know, anything I can do to honor my family, I like to do. Do you want to provide scholarships? What excites you? What are you passionate about? And then before we start talking about, well, what assets do you give and when do you give them? Let's talk about other personal objectives. It could be that tax planning is really important. This day and age, because the estate tax exemption is so high per person, it's like 11.5 million per person, most people don't have to worry about estate taxes, but they worry about income tax planning for annual income tax planning. So they think, well, what is the smartest thing I can do? So that may be it. You may have challenges with loved ones. Through the years, I've talked to many people who had to set up special needs trusts. And so I like to know, what are you thinking? I've talked to a lot of people that were worried about diversification and concentration of their assets. So once we start learning, and I love it because I get to play the role, Chris, get to play the role of advisor and help, but we work in tandem with their advisors with ideas. And then we finally get to the middle bucket, which is, well, what assets do we have to work with? Let's figure out what makes the most sense, and then let's figure out when it makes the most sense. And a lot of times we'll come up with a mixture of things, Chris. We'll come up with different assets. We'll come up with some now, some later. And as you know, in our industry, we call this blended gifts.
Well, and I like that you brought up blended gifts, and I'm going to make a note of that because I want to get back to that later. Tuck it away for now. Those are very much increasing in popularity. So let's start at the more granular and talk about gifts of cash, because I think that in my role and in your role, when we start talking about giving, some donors naturally think about gifts of cash first. So how can someone make a gift of cash while being strategic about how and when they make that gift?
That's a great question, and you're right. Most people take out their checkbook and they write a check. And there are 2 other wonderful opportunities right now. If you qualified, if you have those assets, for those people who have long-term meaning you've held an asset for a year and a day or over a year, highly appreciated securities. A lot of times people are concerned like, gosh darn, I don't want to pay all of those capital gains taxes. So gifting those long-term appreciated securities really makes sense whenever you're supporting a charity. So that's a way to do that, and then you've saved yourself all those taxes you would have paid if you had cashed them in. The other thing is with IRAs, if you're lucky enough to be 70 and a half, we have what is called a qualified charitable distribution. And that means you can give up to $100,000 a year directly from that individual retirement account to nonprofits, the charities you love. You can give it in pieces and drabs, but you just can't go over 100,000. And you don't receive any charitable income tax deduction for that. But for those people who have spent their entire lives building their retirement accounts, because we were all taught to do that, my generation and older, save all you can, you get that out of your account and you never have to pay taxes on those. And so our donors love it. Last year at Carolina alone, we received $5 million in annual gifts that were just from using these qualified charitable distributions. So it's worth talking to your advisors about if you have an individual retirement account and you're 70 and a half.
So yeah, let's spend an extra few moments on retirement plans. What makes a retirement plan such an efficient and simple way to support causes that are important to you?
I love talking about retirement plans for a couple of reasons. The tax advantages are really important. So think about it. When you give your retirement plan to your spouse, they can just roll it over, right? That's fine. But what about the next generation? What about other people that you love when they receive a retirement plan? They have to pay taxes on it for any amount they take out in their tax bracket. However, if you give retirement plans to nonprofits, we don't pay taxes. So we get the full 100%, we get the full bang for our buck. So I always tell people when you're planning, give your loved ones the assets where they'll get a quote unquote step up in basis, like their securities will go up to the date of death value. So they'll have that stepped up in basis. Their houses, life insurance, give your loved ones the assets where they can get the most bang for their buck, and give the charity the asset, the retirement accounts, so that we can get the full 100% of that. So I'm very excited about those. And I've already mentioned the IRA rollover. And then at death, then it's a beneficiary designation. And for those people who feel, I run across people who feel that they just completed the last rendition of their trust or will, and so they really don't want to go back, but they want to do something now. I talk to them about beneficiary designations, about their retirement beneficiary designations, because that is by operation of law. So that is a form that you complete outside of your will or trust. And now, which I think we're probably heading into now with the Secure Act, there is, for those people who are really charitably minded, they have another option to consider with these retirement accounts.
Well, and I do want to mention, really quick, that the charitable IRA rollover. Thank you, Mr. Adams, Austin. The qualified charitable distribution does count towards your required minimum distribution as well, and so you can sort of knock out two things with one stone there if you're so inclined.
Exactly.
But you mentioned the Secure Act.
Mm-hmm.
What should we know as it relates to gift planning? It seems like this giant beast of legislation that tidbits are out there. How did it affect charitable giving?
You're right. There were tidbits out there everywhere, and it was a huge act. But for our purposes, first of all, it was passed in December 2019. It's hard to believe it's been less than a year since it passed. But what happened was they raised the required minimum distribution to age 72 from 70 and a half. So they gave people extra time to save, extra time to not have to take withdrawals. However, there's something they did that really affects what I was talking about when the retirement accounts go down to the next generation. And that is they put a 10-year limit on it. So back to a non-spouse beneficiary. So they inherit a large IRA from a parent. That used to be what we called, they'd stretch them out. We call them stretch IRAs. They just stretch them out either depending on when they occurred and how old the parent was, over their lifetime or over their parents' lifetime, but they got to stretch out the amounts they took out. Now they have to do it all in 10 years. So what does that do? That makes them pay more taxes over those 10 years. It might raise their tax bracket, their income tax bracket. So it could make a substantial difference there. And a lot of times parents looked at that as a way for their children to have secure income for the rest of their lives. And now they don't, because it's going to all be out in 10 years. So we're going to touch upon this throughout. This theme is going to be throughout this talk. But people are now looking at charitable remainder trusts in their estate plan. And what that means is they set up a charitable trust naming Wittenberg or a number of charities as beneficiaries, and their kids get income every year until they die. So it's a way to replace the stretch IRA to make sure your loved ones get income every single year. It's also a way to support charity. And we're seeing more people talk about this since this act passed in December.
And so more recently, I see that the CARES Act is also on our screen, and it was passed in March. So what sort of changes has this brought to charitable and gift planning?
Well, for this year alone, so we just have 3 months, you don't have to take any RMDs. Nobody has to take any RMDs. I do want to say you can still do that qualified charitable distribution. And you could do it under the Secure Act. That 70 and a half age is still there, and you can still do it this year if you want. One of the things that I think is really cool is, this is back to if you do want to write a $300 check to a public charity like Wittenberg, you may, and you can take a tax deduction above the line. Before you even get to your adjusted base to figure out taxes, above the line, $300 can come out per tax filing. So it's not per person, it's per tax filing. And it has to be you have to be a non-itemizer, but about 91% of the people in this country are non-itemizers. So it's a nice little nibble. I know that it doesn't seem like very much, but as we've learned with laws and charitable laws, once something becomes a law, it's easier sometimes to increase that amount. And there are rumblings in Congress that some people are in favor of increasing this amount. So down the road, we could even see something more wonderful in that regard. And then also, if people give cash to public charities, and this is not donor advised funds. If you have a donor advised fund, this does not count. Let's say you earn your adjusted basis this year, your adjusted gross income is $100,000. If you give $100,000 in cash, you can take that full amount. You can take up to 100% adjusted gross income as a charitable deduction, again, this year alone. So this is where you really want to talk to your tax advisors and make sure it's the right thing for you, because in some cases it may not be. It still may be better just to take partial and roll it over for the next year. But still, it's an opportunity that's out there.
Well, yeah, there is quite a bit going on with tax law and particularly charitable tax law right now. And so like Elizabeth just said, I would encourage viewers or listeners to explore options with their financial advisors to see if any of these incentives make sense for them this year or in the future. So Elizabeth, getting back to our more general topic at hand, what are some other strategic solutions for donors who are not able to consider gifts of cash? Can they still pledge support for an organization's charitable mission while maintaining control of their assets?
Absolutely, Chris. And this gets back to, remember, you and I use the term blended gifts. I am constantly working on real estate gifts. Again, people don't want to pay the capital gains. They're tired, it may be a vacation home, and they're tired of the maintenance and the taxes. And they say, you know, I'd like to give it to you and support my favorite area on campus. Tangible personal property, we keep receiving artwork at Carolina. We're building our museum, and a lot of beautiful art pieces are coming in. Closely held business. I'm always working on a closely held business asset. So there are all different types. Life insurance policy. You know, one thing is sometimes people have old life insurance policies sitting around. They don't really need them anymore, but there's some cash surrender value. You can gift those to Wittenberg, and Wittenberg can surrender it right away. And then all of a sudden, boom, you maybe are starting an endowment or supporting a scholarship or a program you love. And so that's the fun part of exploring all of these ideas. And then I don't ever want to leave out the importance of a beneficiary designation or a bequest. It is the great majority of what we do as gift planners, even though we do all of the blended and look at everything. Still, for many people, a bequest is the time where they can make their largest gift. And remember, I was talking about peace of mind planning. Back to my donor who was in his early 80s moving into a retirement home. He was a little nervous. He was comfortable, but he wanted to make sure there was enough money for all the health costs that he and his wife would incur and the expenses. So for him, it made sense to do something smaller now and then make a huge impact at death, which he did. So I would never take away from that idea either. What about you, Chris? Tell us what's going on at Wittenberg.
Yeah, I know the impact of bequest gifts to Wittenberg is quite substantial every year, and I think that donors know that they may not have the cash available for an outright gift or pledge, or uncertainties like you mentioned, health, length of life, or caring for parents, or so forth, or children. Uncertainties make it unrealistic to consider an outright gift like that. So instead, a lot of donors provide a gift to Wittenberg, an area of campus that's meaningful to them through an amount or a percentage of their estate. And I would say the vast majority of these gifts have enabled us to partner with alumni and friends to create endowed funds that continue the donor's annual gift after their passing, and it creates this perpetual legacy of supporting Wittenberg, if you will. However, I want to say that beyond bequests, and this is what you were talking about, our team has explored unique gifts such as tangible assets, vacation homes, life insurance with donors and their advisors, and that's what we're here for. So a quick story, a short time after I started at Wittenberg, we had a donor who explored a retained life estate agreement with Wittenberg, and she knew the name of it, but she didn't necessarily know what it was. And so essentially a retained life estate agreement is where the donor would irrevocably gift the home to Wittenberg. And in exchange for the gift, the donor would receive an income tax deduction immediately when the gift happens. And the donor would have been able to live in the home until their passing, or they decide to move out. So in the process of discussing this with the financial advisor, all of us sort of came to the conclusion that it wasn't the right time to explore this type of gift. But I tell this story because it was a greater gift than the donor otherwise thought would be possible, using an asset that she didn't even know that we would be interested in. And we haven't ruled out returning to this option in the future, either during the donor's lifetime or through their estate plans. So it is possible to talk through opportunities and ideas for gifts using assets that a donor can still control during their lifetime. And Elizabeth, you were telling me a story about blended gifts that was very similar using this team approach.
I was, and I will tell you that story. But Chris, you just reminded me of something that you and I really didn't discuss because it's just an innate part of what we do. But I have turned down gifts, not because they weren't good for Carolina, but because they weren't good for the donor. And I couldn't sleep with myself if I let them move forward with what they wanted to do. And so it's very important that we are involved and that we honor and respect and take care of our donors. So I just wanted to throw that out because it's just something innate that you and I do, but it's very important. So my blended gift story, I had a gentleman a few years ago come forward and he wanted to make a gift of $500,000 now. I was trying to figure out how. Luckily, I knew his estate planning attorney really well. She's awesome. And she pulled in his broker. And the three of us got on the phone and we hammered out. We realized that he could do $100,000 from his qualified charitable distribution in December, and then turn around in January, a new year, do another $100,000, and then 1 year later, do a third $100,000 in a new tax year. And we uncovered an old life insurance policy with a cash surrender value of like $230,000. So in 13 months, we had $500,000 in the door. And so it was really fun to join with the advisors, to talk about how this worked, to share ideas and figure it out. And the donor was thrilled.
It can take some creativity to accomplish some goals.
And it's fun. It is just
it is
fun.
So Elizabeth, we've talked and mentioned charitable gift annuities and charitable remainder trusts, and can we talk about ways that these can maybe provide more security for oneself or one's family, while at the same time furthering someone's charitable interests?
Absolutely. Absolutely, Chris. As you and I know, they're called life income gifts, and they're very popular, whether it's a charitable remainder trust or a charitable gift annuity. They come in different flavors, but really what it means is you irrevocably give money now to that charitable gift annuity, which is a contract with Wittenberg, or to the charitable remainder trust, which is a total separate tax entity. And in return, you or you and your loved one receive income for life. And the reason why I say there's different flavors is the gift annuities, you can get a set amount for the rest of your life. With the charitable trust, there are different things you can do. You can get an amount that is tied to a percentage, but revalued every year based on how your trust did. And the younger people are like in their late 50s, early 60s when they set these up, they like those because they figure over their lifetime, the market is going to make the trust grow faster than the payouts they receive. So they like that kind of trust. Older people who are retired sometimes say, I just want security. And so they like the gift annuities. So we can't use that money while they're living, but because it's irrevocable, we know it's something we can count on in the future. And it also helps so many people with peace of mind. I cannot tell you how large our trust program is. And every single one, as I think of all of our donors, it was a solution for something.
Yeah,
You want to talk about our annuity program at Wittenberg, Chris?
Sure.
Is that a
Sure.
time?
So,
Okay.
Like you said, the gift annuity options are can be very flexible and tailored to your interests. And here at Wittenberg, and I'm sure it's the same at Carolina, we offer both an immediate gift annuity, which is you make the gift and you receive payments starting right away, or a deferred gift annuity where you make the gift today and receive the deduction today, but then don't receive payments until the future, and that may actually increase the amount of payout that you receive. And I will say, I'll second what you said. They're attractive to alumni looking to either diversify income streams or I like the peace of mind idea that you brought up in retirement, or maybe a life situation necessitates that. So here at Wittenberg, we can run sample calculations that will help you and your advisor evaluate things like payout rate, timing, the annual amount of income, as well as tax deduction, of course. So boy, yeah, we've talked a lot today about the many ways gift planning fits into estate planning. And Elizabeth, something that I think both you and I would recommend is talking about your estate with organizations that may benefit from it, because it can ensure that your charitable interests are documented, and even more importantly, your intentions for the legacy that you want to leave can be executed properly. Do you agree with that?
I totally agree with that, Chris. And my department also handles all of the probate administrations for the charitable gifts we receive. And every year my heart breaks over 2 or 3 that come in because the donors didn't let us know. And I understand that. And we keep a lot of donors deeply anonymous because we honor their requests for confidentiality. But it breaks my heart because they asked for something they couldn't do, or they named a foundation incorrectly, or it's just plain not clear what they wanted. We didn't know. And here they are making us a part of their family, a part of their values, a part of their estate. And we never had a chance to thank them, and we never had a chance to clarify. So I really do think that documentation is important. And that's why we have a legacy society. And I know we have one at Wittenberg.
Right. Yeah. Here at Wittenberg, we have the David Hawley Legacy Associate Society, and it's essentially the giving society for those alumni and friends who provided for Wittenberg through their estate plans. Um, this year's been an interesting year, I think, for all of us. We've had many alumni notify us this past year of their intentions, and that allows us to ensure that we can follow their wishes when the time comes. And we can also, it happens, to count, your generosity for the current comprehensive campaign. So this society is an opportunity for Wittenberg to thank you and to recognize your generous consideration of the university and the legacy that you will leave here, just as many others have throughout Wittenberg's first 175 years and the 175 years to come.
Well, and Chris, if I may, I'd like to take a moment to encourage my fellow alumni to join me in ensuring Wittenberg's future success. I have tigered up, and I have named Wittenberg in my estate plan. And it makes me really happy to be able to do this. And it gives me peace of mind knowing that I'm going to help Wittenberg continue on after I'm gone.
Well, thank you, Elizabeth. Your support means a great deal to us, and we're very grateful for partners like you who understand the value of planned gifts to Wittenberg and the legacy it can leave for donors like yourself. So that sort of brings us to the end of the prepared portion of the presentation, but we'd love to open it up for questions in the chat room or otherwise, if anybody has any questions that we can address.
Is there anything we didn't cover that someone would like to cover? Quiet group.
Elizabeth, I will ask a question. The donor advised funds, that's becoming very popular, hasn't it?
Yes, extremely popular, yes.
Any, like, I know you mentioned it. I don't know if I caught exactly what we could do. Full disclosure here, I'm in the business too. I'm at Roanoke College.
Oh, great.
But, I'm still, there's still a few things that I'm learning always, but I know that's a term that's really come up recently, and I'm not real clear on all that.
Okay, I'd be happy to talk about that a little more, and I realize I really didn't flesh it out much. So, and I started my career at the Columbus Foundation, a community foundation, and so I'm a huge proponent of donor advised funds. But the beauty of donor advised funds is when a person either, perhaps they have a large income year and they want to take care of different charitable organizations, but they're either not sure of the amount or they prefer to space it out over a few years, something like that. So if you put it into a donor advised fund, you receive that charitable income tax deduction when you put it in there. So you've irrevocably given it away. It now belongs to either the Fidelity Advised Fund or the Schwab or the Community Foundation, whoever offers donor advised funds. So it's in there. And then when you would like to see a charity benefit from it, you write a letter of recommendation to the board of the foundation. They make sure it's a legitimate 501c3, and then they'll approve the payout. So you suggest, because you have no control over it, but reality is as long as it's a legitimate 501c3, they're going to honor your request. Well, what we're looking at this year at Carolina, because donors, quite frankly, have been a little nervous with the whole COVID and the market and everything that's going on. And we receive a lot of money from donor advised funds. We are talking to those donors if they had put a big chunk into those funds, a year or two ago, or have a large amount sitting in the funds. We're hoping that they would consider releasing a nice annual gift, or even maybe enough to start an endowment this year. They're not taking anything out of their pocketbooks because they already gave that away. And so it can make a wonderful current gift to Wittenberg, to Carolina, to any nonprofit now, and just by them writing a suggestion. The other thing that I'm looking at with donors are what happens after you die with that donor advised fund. Are you allowed to designate a payout to a charitable institution, like a full payout up front, or does it, dribble out in drabs? If so, can we still be one of those charities named? And so we're uncovering ways to support without causing a donor to have to spend any additional money now. Does that make sense?
Yeah.
Thank you for the question.
Okay.
Yeah, and Jack, I'll just back up what Elizabeth said. I think that donor advised funds are going to continue to grow in popularity, and all your there's Vanguard and Fidelity and your Schwab, and they all offer donor advised funds. Your community organizations, your community foundations probably have a donor advised fund option. Saw that Fidelity just got rid of their fund minimum needed to create a donor advised fund. So, recognizing that those gifts are going to increase in popularity, I know that charitable organizations like Carolina and WIT are much more attentive to those types of gifts and making them available to donors, and how do we help donors through that process?
And one other thing, Jack, so you, the donor, already received your charitable income tax deduction when you funded the donor advised fund. But when it comes to Wittenberg, you'll get a gift in kind credit. In other words, we know that you were the one that caused that to come here. And so we recognize that.
Okay. All right, good, thanks.
My pleasure. Anything else?
What else have we missed?
What's in the chat? Okay. Great. Okay, I was just checking to make sure there are no other questions in the chat room. Okay.
This is Austin. Can you hear me?
Yes.
Okay. Didn't know for sure mute was off. In any case, you mentioned donor advised funds, and this is something I've employed for my own planning. But there is oftentimes when you're working with financial advisors, sometimes they like to maintain control of the assets as a part of the relationship with their clients. There is a company, goes by the initials of AEF. I think it stands for American Endowment Foundation or something along that line. It specializes in working with independent financial advisors so that they continue to manage the funds, and the client then is real active in making the suggestions to the fund as to how it becomes distributed. And that's sometimes advisors will be more encouraging to supporting this donor advised fund rather than sending the assets off to Fidelity or Schwab or something like that. So.
That's a good point. And the example that I gave about the 300,000 qualified charitable rollover plus the life insurance policy, when the estate planning attorney began working, he was resistant at first. And I was scratching my head as to why, when this is something the donor wanted. But when he stepped back and thought about it, he realized it really was the best thing for the donor. So that's where I like being involved as a team so that we can talk through this together. But ultimately, it should always be about what the donor wants and if it's right for them.
There's another story that I have, if you don't mind me sharing the story.
Not at all.
I had a couple that unfortunately the husband was in a health situation where it was not going to be long-term and a usual life maturity. But he had a life insurance policy for $600,000 that he had been paying for. The couple themselves wanted to gift $100,000 to a medical school. But this policy was for $600,000. So I went to the school and talked with them anonymously for the client. Would the school be interested in assuming a portion of the life insurance policy? And so, in fact, they started thinking about it, and they intimately knew the health of the individual, the potential donor, as that was revealed with permission. And so the couple continued to pay the premium that was allocated to $100,000. So they made a gift effectively of $100,000 in a couple of years to the university. And then the other $500,000 of death benefit went to the university for other uses. So it worked out.
That's a great story. Thank you. Anybody else? Well, my contact information is on the last page, and I'm always happy if anybody wants to reach out, and I know Chris is as well.
Yeah, so feel free to reach out if any other questions come to mind. I'm so grateful for the chance to get together, and Elizabeth, thank you for sharing some of your expertise with us, and you know, I hope that we can all enjoy this homecoming weekend. I know we've got lots of other talks planned, and we've got a toast to Wittenberg tonight at 4:30 that I hope you'll join us for. And go Tigers, always.
Go Tigers. Thank you, everyone.
Thanks, everyone.
Thank you.